Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, all signs are clearly now pointing to a housing market crash or correction, reset, negative equity growth, cool down, whatever you prefer. So the real question for me that I'm asking myself, y'all, is when will the Federal Reserve flip-flop and how long will buying opportunity be there? Because you guys know as well as I do, when it's time to buy again, there's going to be so many investors and institutional investors that come in and swoop houses, but don't let that intimidate you. You're still going to be able to purchase homes at great deals so long as you prepare. And I've told you guys, I'm double downing on myself on preparing to purchase real estate at the end of this year and into 2023. After that, it's possible the Fed flip-flops, makes things more affordable, and inventory goes bye-bye once again. So that's my plan, you guys. But what we're going to do today, you guys, is we're going to unload an article from Zillow titled Impacts of Rising Mortgage Rates, a conversation with senior economist Matthew Speakman. So you guys, essentially, we're going to look at what the Zillow economists are saying, what advice they're giving, and then we're going to talk about whether or not you agree with what they're saying or not, right? But remember this, you guys, I'm not a financial advisor, even if I want to be. My bio, right? My bio is as a realtor, loan officer, and instructor, but this is my personal YouTube channel where I'm just sharing with you guys my thoughts and my opinions. And if you can, for all of the effort I'm trying to get you guys a video a day, please like this video, subscribe to my channel if you haven't, and as always, please comment below. You have no idea how many people you guys help. You guys probably, some of the commenters with these great insights, you guys probably help hundreds of people without even realizing it. So thank you. But let's get started on this article right now. So here's the question. What is causing this rapid rise in rates? Here's his answer. A number of factors have pushed mortgage rates firmly higher this year, but inflationary pressures are the main culprit. All else being equal, inflation places upward pressure on bond yields, which generally dictate the path of mortgage rates. Inflation is running at a 40-year high, and mortgage rates have, by some measures, seen the highest annual growth since the late 1970s. Needless to say, investors are eagerly searching for signs that inflation is cooling. Hints of calming price growth in May led mortgage rates to temporarily plateau, but May's official inflation data came in hotter than expected, prompting a tremendous strong surge higher for mortgage rates in the days that followed. He goes on. Mortgage rates also reflect markets' expectations for how the Federal Reserve is going to tighten monetary policy in order to rein in rising prices. Somewhat confusing. The Fed's actions are actually less influential on mortgage rates than the market's expectations for what the central bank is going to do going forward. Fears that the hotter than expected May inflation data would lead the Fed to make a much more aggressive policy decision helped influence the rapid hike in mortgage rates in mid-June. The bank's actual decision to increase overnight rates by 75 basis points actually resulted in a decline in mortgage rates. Mortgage rates remain very high compared to recent years. They've come down a bit since the frenzy of mid-June. Inflationary pressures are showing few signs of abating, but the Fed's insistence that it is strongly committed to curbing inflation has caused some investors to soften their growth outlook for the years ahead. This change in tune has introduced some downward pressure on bond yields and thus mortgage rates in recent days. You guys notice how that economist didn't mention anything about the stimulus or the PPP, the free money and the cheap money and the COVID lockdowns? That's kind of interesting, right? Why would they leave out why this happened to begin with? But regardless, you guys, what I also find interesting is essentially he's saying this, that regardless, whether or not the Federal Reserve meets, this month in July, September, and they raise rates, what he's saying is the mortgage interest rates will not go up, right? He's saying that the mortgage interest rates already have that priced in. What I'm saying is the mortgage rates are going to go up. So an economist is saying they're not. I'm saying they are. We're about to see what happens regardless. But comment below if you have any opinions on that matter. But I did like how he explained the correlation between bond yields and mortgage rates. Let's continue on with the article right now. All right, next question. What do you think will happen to rates in the future? It's always extremely difficult to predict mortgage rate movements, particularly at a time with such economic and geopolitical uncertainty like there is today. As an example, there's been a general belief mortgage rates would rise this year, but few could have predicted what has played out over the last few weeks, both the surge higher in mid-June and the pullback of rates in recent days. As I mentioned earlier, concerns about persistent inflation will continue to have a strong influence on mortgage rates until there is ample evidence that price growth is easing. The pandemic and geopolitical developments are also inputs into this calculus. Concerns about the economy's longer term growth prospects and the potential of a recession in the near future are also factoring into markets' outlooks for bond yields, which generally influence mortgage rates. So the reality is, you guys, is mortgage rates are going to go up and we are in a recession. So I don't understand why so many economists aren't taking into consideration the recession that we're probably in right now. And even if it's not confirmed, the data is tainted because of inflation, right? And if it's, or another reason it's not confirmed, they change the definition, which is absolutely crazy, you guys. But it is really shocking to me that so few people take into consideration recession, right? I think they're going to have no choice but to start doing that, hopefully at the end of this month, once the recession is confirmed, because I'm really anxious to see what their projections are once they start becoming more realistic. Let's continue. Next question. What impact could this have on the housing market? Here's his response. Higher mortgage costs should calm demand and usher in some much needed rebalancing of the market. Combination of the record-breaking pace and home value growth and suddenly high mortgage rates has severely worsened housing affordability. Our affordability measures show that a monthly mortgage payment on the nation's typical home makes up a greater share of median homeowner income than any time since at least 2007 and possibly much longer. Then worsening conditions are already having an impact on the market. Home price growth has started to soften and price cuts are becoming more common as sellers are finally being challenged and begin to reconsider their expectations. You guys, so right before the Great Recession, we're at those levels of unaffordability. Think about that right now. We're at the levels of unaffordability. Now ask yourself this, are things going to get more expensive or less expensive going into 2022? Remember, school loans haven't even started. Property taxes really haven't kicked in from new assessed values. Homeowners insurance is more, medical insurance is more, gas, food. So many things are more. Some EIDL loans haven't even started. So things are only going to get much more unaffordable. And the Federal Reserve is going to continue to rate hike. Mark my words, you guys, things are going to get worse before they get better. Let's continue on with this article right now. Okay, and here's the last part of this article, y'all. It is important to remember that while mortgage rates are certainly not the only reason why homeowners decide to move, they do factor into the equation. And for some potential movers, the prospect of giving up their current mortgage and taking on one with a rate that is nearly double their current one is enough to back out of the transaction, which is true. But still, like it says, people are going to move for various reasons, not just rates, right? But here's the question. What would happen if rates went back down? Now, this is a good question. Listen to what he says. A sharp reduction in mortgage rates would naturally re-energize activity in the housing market and incentivize some buyers and sellers who are currently on the fence to jump back into the market. Overall affordability challenges would persist as prices remain high, but it's unlikely that many potential buyers, particularly those first-time buyers who have faced an extraordinary competitive market over the past couple of years, would view lower interest rates as an opportunity to finally enter the market. On the seller side, those who are concerned about having to take on a higher rate if they were to give up their current one would of course be faced with an easier to digest scenario. And you guys, here's why I want to end the video. I want to end that video dovetailing off of that. This is essentially why I'm telling you guys right now, double down on your preparation. We don't know what's going to happen. Well, we don't know what's going to happen at all, but especially election year. I believe it's possible that election year, the Federal Reserve flip-flops, making the housing market much more affordable, bringing back buyers, and destroying the progress that we've made with recuperating our inventory. I believe that's possible in 2024, and that's why I'm saying double down now so that you can take advantage of buying opportunities at the end of this year and into 2023, because outside of that, it is a crapshoot. It's a crapshoot right now, but it's especially a crapshoot when we enter those election years. Think about that, guys, and decide what's best for you. But as always, you guys, I really appreciate you watching my videos. And if you're out there investing in real estate, I wish you luck and I hope you win.